Clearly from a fundamental perspective, I think things are in place and there is not much of a worry in terms of either the macroeconomic fundamentals or in terms of corporate fundamentals playing out as expected by the markets. However, what needs to be kept in mind in 2024 is we are entering this market in a phase where it has already given substantial returns over the past 1 year as well as past 3 years. And these returns seem to be much higher than the trend line returns that we have got in the past. So, to that extent, valuations have definitely moved up. So, one needs to be cautious of the valuations and accordingly place their bets. For a medium to long term investor, we still believe that things are still fine. Usually at Kotak Mutual Fund, we do not bet on events because there is no way to predict some of these events. But very clearly, I think there are various areas where the government focus will continue to be there. For example, the ones that you mentioned, defense, railways, infrastructure, etc. These are the themes which will play out for the next several years. It's not that just because of one calendar year or one financial year, some of these themes will run out of steam. So to that extent, yes, we do believe that capex beneficiaries or beneficiaries from inadequate infrastructure development that has happened in the country and where government is refocusing. These are some of the areas which will continue to gain focus and which will continue to offer medium to long term growth. However, as I mentioned earlier as well, there are many pockets in the market which are quite expensive at this point of time. So to that extent, one should not just go by the growth characteristics, but also keep valuations in mind. So wherever you find relatively safer opportunities, that's the way to build a portfolio. Yes, clearly even the large cap index is now trading at a valuation which is more than the historical average valuation. So to that extent, yes, there may not be easy money that is going to be made in the near term. As far as mid and small caps are concerned, clearly the valuation comfort is a lot lesser. As you go down the market cap curve, as you go down the liquidity curve, there seems to be a lot of richness in terms of valuations. And many of these pockets are not necessarily driven by just fundamentals. They're also driven by how money flow has been in the recent times. So to that extent, obviously the cautiousness increases as you go down the market capitalization curve. See, clearly, I think there is merit in moderating expectations on returns because what we have seen on especially mid and small caps over the last 1 year or over the last 3 years from the COVID bottom is unlikely to get repeated every year, every 3 year block. The kind of returns that you have seen where mid and small caps have outperformed large caps by about 20% in the last 1 year. And even when you look at the CAGR returns, over the last few years, that's been the kind of returns that they have made over large caps. So I think that's unlikely to be sustainable. So on a base case, one should be looking at more moderate returns, more in line with earnings growth, and also with a lot higher volatility as compared to what we have seen in the last 1 year. Markets are never one-way street. They may have behaved like that in the past couple of months or couple of quarters, but unlikely to remain that way. And as you go higher on valuations, there can be any risk, internal or external to the economy, which can come and derail the momentum at any point of time. So to that extent, one should be ready for more volatility in the markets. More volatility does not mean that you will not make returns. You will make returns, but maybe more moderated level of returns as compared to what has been seen in the past couple of years. As I mentioned earlier as well, we do not bet on any of the events. So rather than that, we analyze fundamentals and valuations and keep looking at it from a more medium to long-term perspective. When we do that on defense of power, clearly the runway for growth seems to be quite large. As far as the power sector is concerned, I think the demand-supply mismatch continues to be in favor of power producers. So to that extent, I think power prices will remain strong. And also there is going to be enough momentum on the power capex side, which will again benefit many of the other ancillary companies as well, along with the capital goods and engineering companies. As far as defense is concerned, there is a clear focus by the government to increase indigenization levels in the defense sector, and also in terms of the growth opportunities, not just the domestic market, but the exports market is also something which is looking very attractive at this point of time. Given that there are many conflicts going on, I think there will be more and more requirement of ammunitions and defense equipments, and India can capture this opportunity from an exports perspective as well. So definitely from a 3 to 5 year theme, these two definitely look good. However, as I said, every pocket of our economy, not just defense and power, many others as well, have re-rated quite substantially over the last couple of years. So to that extent, one should be mindful of the valuations and the volatility that could come in at higher valuations. We have already spoken about a couple of things. For example, capital expenditure beneficiaries, when investment cycle is turning up, entire space is likely to do well. And also the areas where there was inadequate focus by the government in the past, and now we seem to be getting a lot more renewed focus on defense, railways, infrastructure, etc. So those are the other segments where one can look at investing. Apart from these two themes, clearly the financial services sector remains to be one of the key areas. It may not have performed so well in the recent times, but if our economy has to grow at a pace of, let's say, 6.5, 7% on a nominal basis of 10% plus, definitely financial services will have to grow. And whether you look at the lending side or the non-lending side, the penetration levels have been very, very low, and there is a long runway for growth in that segment. And as far as lending side is concerned, we are unlikely to see any asset quality issues anytime soon because we are at a nascent stage of a new cycle. So overall, this segment looks much better from a valuation perspective, and also from a medium-term outlook perspective, it looks quite good. We are expecting about 17 to 18% CAGR earnings growth on the Nifty basket for financial year 24 and financial year 25. Yes, the first half has already played out. It has been much better than what the full year numbers have been. We have seen about a 25% earnings growth for the Nifty basket during first half of financial year 24. But we do believe that second half is going to be slightly more moderated, especially given that the base effect will come into play, and it may not be such a favorable base as compared to the first half. But still, for the financial year 24, we expect Nifty earnings to grow at close to 20% or so. And next year, probably it will moderate a little downwards and be in the mid-teens. Overall, I think these are healthy growth numbers that the market is expecting. So give or take a few percentage points, if these numbers are achieved, I think markets can sustain these valuations, albeit a little bit of more volatility, I would say. Hardly any pocket which is at very, very attractive levels, as the overall market itself is a fair zone or a fair zone plus kind of levels in terms of valuations. But within that, I would say large cap banks and maybe a few stocks in the pharma sector are the ones which offer a little bit of a downside support because of the valuations, and also because of not so high institutional ownership that has got created in the recent times, which means that in times of volatility, there may not be too much of institutional selling in these baskets. Overall, yes, these are the two pockets where relatively there is a little bit of more valuation comfort.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.